March 6, 2012. The United States Senate called in the experts on the IPO market. They called Renaissance Capital. Congress was about to pass a new law, the Jobs Act. I was in that room. We came with one warning: protect the buyers, protect you. Congress heard our warning, then they passed the law. The door to America's best young companies swung shut, and you were on the wrong side of it. We saw it coming. It's in the congressional record. Today, I'll show you what they buried in that law and how you get back in. Hey, welcome to New Stock Signals. I'm Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. I read every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. When a company waits until it's worth $80 billion to go public, the easy money is already gone. The 10 times, the 50 times that happened in the private rounds you were never invited to. This video is for two people: the everyday investor who keeps hearing you're too late and wants to know why, and the serious investor who wants the mechanics, not the slogan. For most of the last century, going public was a rite of passage. A growing company reached a certain size, and the rules more or less forced it into the open. The deal was simple. You want the public's money? You show the public your books, audited financials, real disclosure, a shareholder count that acted like a natural on-ramp to going public. The old rule said, once you get big enough, the doors have to open to the public. That single rule is why ordinary people got to own the great American growth stories early. Microsoft went public in 1986 at a market value near $780 million, small enough that the enormous growth still sat ahead of it, ahead of ordinary shareholders. That's the world the old rules built, imperfect but tilted toward access. Every few decades, someone rewrites the rules, and the fight is never loud. It's technical. It's boring on purpose. That's how you move a mountain without anyone watching. In 2012, they moved the mountain. The Jobs Act didn't change one rule. It changed the whole on-ramp to the public market, and almost every change pointed the same direction. Stay private longer, disclose less, favor the insiders. Change one, the disclosure got thinner. Before, a company heading public showed 3 years of audited financials. Audited means an outside firm checks the numbers, so you're not just trusting management. After the Jobs Act, 2 years, and 5 years of supplemental history shrank to a selected slice. Less to check, less for you to see before you commit your money. Change two. The on-ramp got moved miles down the road. There used to be a trigger cross 500 shareholders of record, and you were effectively pushed toward going public. Held of record just means the official count of shareholders on the books. The Jobs Act raised that trigger to 2,000. Then it did something quieter and far more powerful. It stopped counting employees in that number. Think about what that means for a company handing stock to thousands of workers. Those thousands no longer push you toward the public market. They're invisible to the count, so you can grow enormous and stay private for a decade, legally, comfortably. That's the machine that manufactures $50 billion unicorns before you've heard the ticker. Change three, a private on-ramp for the favored few. The Jobs Act created two phrases that sound harmless: emerging growth company and testing the waters. An emerging growth company was defined as any firm under $1 billion in revenue, which gave it a lighter set of rules on the way public. The label was drawn so wide it swallowed almost everyone and thinned their disclosure with it. Testing the waters lets a company quietly pitch big institutional investors before the public ever sees a filing. Private conversations, private interest, private pricing signals. By the time the deal reaches you, the real negotiation already happened in a room you weren't in. Thinner disclosure, a trigger pushed out of reach, a wide open exemption, a private pre-market for insiders. That's the spine of the whole thing. The upside that used to be shared in the public market now compounds for years in private hands first. Venture funds, late-stage private buyers, a handful of privileged institutions, and the carried interest on those gains, the favorable tax treatment on the profits the managers keep, untouched, before and after. The one thing they didn't reform was their own cut. Maybe you understand the trap by now, but what's important is positioning around it. First off, kill the "I'm too late" story. Most investors believe the IPO opportunity is gone. That belief is the real cost. The largest class of companies in a generation is heading for the public markets, the AI wave. When they come, they'll arrive exactly the way the Jobs Act trained them to: big, late, and hyped. Second, respect the calendar the law created. These companies go public after the private rounds already ran, so the first print is often the most crowded, most emotional moment. You don't have to buy on day one. There's nothing wrong with waiting for the right setup. setup. Watch for entry points, the first real pullback in the months after listing, and the lockup expiration. Last, read the disclosure as a signal, not a formality. If the rules now let companies show you less, then what they choose to show you matters more. 2 years of financials instead of 3? Fine. Read them harder. Look for the durable stuff, real revenue, real margins. A moat you can name in one sentence. With AI companies especially, is the AI a genuine advantage in cost and speed, or a slide in the pitch deck? The winners translate AI into margins and durable economics. The rest translated into a press release. Don't confuse a big valuation with a big opportunity. The size is often what's already been taken. Don't treat the IPO date as a buy signal. It's a liquidity event for insiders first. And don't outsource your filter to the hype cycle. You don't win this by working harder than the institutions. You can't. You win by filtering better than the crowd. Now, let me be fair, because you deserve the whole picture. Objection 1. The Jobs Act did help some companies raise money. True, it did lower the cost of going public for smaller firms, and some good businesses used it well. I'm not telling you every effect was bad. I'm telling you who the net winners were, and it wasn't the public. Objection 2. Companies stay private longer because private capital is just abundant now. Also true, and it's both. Cheap private money and a law that removed the pressure to go public work together. The point isn't a single villain. It's the direction. Every incentive now points to waiting. And here's where I'll show you my discipline, not false certainty. I can't tell you which AI IPO will win. Nobody honest can. The early leader in a technology is often not the eventual winner. History is full of first movers that never scaled. What I can tell you is how to read the structure and when it's working against you. So here's where we land. A law with a beautiful name rewrote the on-ramp to the public market. It let the best companies stay private longer, handed the early upside to insiders, and sent them public late, quakes after the easy money was gone. The unicorns aren't a glitch. They're the output of the machine. But knowing the design changes how you play. You stop chasing the first day headline. You wait for the pullback and the lockup. You read the thin disclosure harder, not softer. If that's the kind of thinking you want more of, subscribe and give this one a like. It helps the channel reach investors who need it. And if you want the full framework I use to separate the real from the hype, it's in my book, The New AI Stock Edge. Pre-orders linked below. They named it after Jobs, but it was built for insiders. Now that you can see the design, you can stop playing by its script.